Chapter 12, we deal with the bank management and their balance sheet and how they manage that balance sheet. So basically, the bank has to really figure out how they're going to effectively and efficiently manage these different assets that they have, because it's a lot of responsibility. I mean, they're the ones who can spur the economy or contract the economy. So they talk about asset transformation, and that's where the financial institution or the bank is going to transform their savings that they have from their one set of customers into available funds that they can loan to another set of customers. So again, they're taking the two different parties, the savers and the borrowers, and bringing them together, and that is called asset transformation. There's different, obviously, sizes of banks. So we have small local banks or community banks or credit unions. We have a decent amount of credit unions around here. Then there's your big retail banks. So they give you some examples of what those are. But basically, if a big mega bank is going to have more than $1 billion of assets, and a smaller community bank is going to have less than $1 billion of assets. So then the customer base, so like say they give JP Morgan Chase as one of the examples. So that's a big worldwide bank. So they're all over the place, and they deal with not only people, but they deal with businesses, around the world. So they're going to be a huge financial institution and a huge part of that financial system. So then obviously we would never want anything to happen to a bank like that. Then we get into their balance sheet. So again, I teach accounting and I'm a CPA, so I kind of, think in my balance sheet terms of accounting. These are a little bit different. So if you're thinking that way, you almost got to shift it up a little bit. So, I mean, it's a similar equation where it's assets equals our liabilities plus our bank capital, but the assets are cash and reserves, so things that they are holding in their treasury, and then their business loans. So see, that's where you kind of think, the opposite of that. Like if I was getting the loan, it would be a liability to me, but so we're the bank. So the bank holds the loan, it's an asset to them, whether it's a business loan or a consumer loan or a mortgage loan. So all of those items are assets on the bank's balance sheet. Then they can have other assets, like they can also do investments. They can invest in government bonds, they can invest in stocks and mortgage-backed securities, and those would also be assets to them. Then their liabilities are the demand deposits. So like when I put money, my paycheck goes into my checking account, that's a liability to the bank. They owe me that money. I could go in today and get it, or tomorrow. So any demand deposits, checking accounts, or savings accounts. If there are loans from other banks, so say they took a loan from the Fed, again, that's that lender of last resort, they could go and borrow money from them. And then if there's any other borrowings that the bank has done, those would all be liabilities. And then the offset to that is the bank capital. So again, if you kind of think about it, again, putting yourself in the bank's shoes, it does make a little bit more sense. Then they talk again about, they give you some examples and charts, but then they talk about the reserve, or the amount of cash that the bank holds. So the Fed they can set that as like you have to hold 2%, but a lot of times they say that the banks are holding more and then sometimes lending less. So then that's not necessarily a good thing, but sometimes that happens. Okay, then we get into the different types. So we have transaction deposits, and those are more of like those liquid. The definition is it's a liquid bank account used by most depositors. So those would be like our checking accounts, where we could just go to any ATM and withdraw. We could walk in and ask for cash. Then they kind of get into some different types of accounts. So they have like demand deposits versus these now accounts. So the demand deposit, and then the now stands for negotiable order of withdrawal. But the demand deposits are, I guess, what I would normally just think of as a regular checking account. I can write a check at any time for any balance that I have in my account up to the entire amount, and I could do it any day. I don't have to give the bank notice. I can just go in and do it. The The now accounts normally are similar, but they can ask for a written notice of withdrawal up to 7 days so that they wouldn't have to give you it all right up front. And then in history, the demand deposits, the checking accounts for a long period of time were not being given interest. So you'd put money in those accounts and not get anything. The now accounts, you were getting interest. So then some things change though. So then it goes through a little bit of a history lesson to say that, okay, back in, so it all changed in the 1970s, it says. So there was this regulation Q that was in effect prior to the 1970s, and that regulation Q forbade any interest to be paid on those demand deposit accounts. So then what people would have to do is they'd have to pull their money out of those accounts and then go and open a now account to get the interest. And then they said at that time, sometimes the banks didn't have both. So they may have a demand deposit account in one bank and then have to go over to like a savings, loan, and trust bank to then make those deposits. And that was a pain. So then there was an individual who came around, his name was Hazelton, and he changed that. So he came in and he was very frustrated by it, and he made some changes and he created a savings account where we could put our money into it and earned interest, and then still be able to withdraw it at pretty much at any time. They do say that there could be some restrictions on that, but for the most part, you can walk in and withdraw anything out of your savings account. So then we credit that Hazelton for creating our modern day savings account. And then they talk about a time when we used to, and it was when I was a child, it was like this. I guess that's on the next page, but we used to have Passbook savings account. So you'd have this little book that was about the size of a passport, and you would take it into the bank when you made a deposit, and they would run it through, and it would show, okay, you made this deposit. If you made a withdrawal, they'd run the book through. So then you took that little book home, and then you always knew how much you had in your savings account. As a child, I remember having one of those and, taking it to the bank and making deposits. So obviously nowadays everything's computerized and we don't need that. So I kind of jumped ahead a little bit though, because that's our Passbook savings accounts. But then we also talked about they also talk about money market deposit accounts. So those again are normally you would have a higher amount, and you'll hopefully get a little higher rate of interest in those money markets accounts. But some banks say maybe you have to have $2,000 or $10,000 or a certain minimum to open up that money market account. It depends on the bank, and I think they're getting a little more flexible with that. Where like a savings account, you can have any amount. Then there's CDs or certificates of deposit, and those are where your money is going to be locked up for a little longer of time. I mean, you pick it. So you can go in and get a CD from a bank, maybe just a 30-day one, but it could go up to a few years even. So it depends on what the banks are offering. But normally they're shorter term, but it says they could go up to 10 years. And then if you're gonna lock your money for 10 years, you hopefully better be getting a good rate of interest. But sometimes people will do those CDs because even though your money's locked, if it's just sitting in a savings account anyhow, you might as well at least earn a little more interest in the CD. Then some other liabilities that they have federal fund purchases where it's monies that have to be paid back to the Fed, and those will show up as liabilities on the bank's balance sheet. Repurchase agreements where the Fed buys it for a short period of time and the bank agrees to buy those Treasury securities back. It's just kind of a way to get money on the short term. There can be subordinated debt. So then those are going to be, it's bonds that the bonds are subordinate to the depositors. So the bonds are issued by the bank, but again, if there's a case of default or a case of having to pay those off, the depositors will all get their money first. So it's a way the bank can borrow money, but again, it's going to be a lower level of priority than the depositors who would be their main creditors. And then there are Euro-dollar accounts where these are savings accounts that are outside of the United States. And it does say they don't have to be in euros, but they're just called Euro-dollar accounts. And then could be other borrowing, like I said, where they borrow from the Fed. If the Fed has those auction windows and they go in and they borrow. We talked about those in the last chapter. Then the next section, we deal with their assets. So their cash on hand, either in the vault or in their drawers of all the cashiers. That would be their cash on hand. And I'm sure they keep a certain dollar amount just knowing on how their business is. So probably every bank is different depending on the magnitude of business that they do. They can hold securities. So again, securities would be like stocks. They could do mortgage-backed securities. They could do stocks of other companies. They could do government bonds. Those are all things that they could invest in and hold. Then their bank loans, they have short-term business loans, and then there's a whole variety of those. So there's self-liquidating inventory loans where they loan you money so that you can have the inventory if you're a retailer. So I think of car dealers, they normally do that. A lot of times they don't borrow from the banks, they borrow from like their manufacturers like Chrysler, Ford, and Dodge, or General Motors. But I suppose it could be from the bank too. So then what they do is they say, okay, I need the money to put all the cars on my lot. So I've got 200 cars out there. I'm borrowing from the bank. As one of those cars is sold, you have to pay the bank whatever you owe them, or whoever financed you. And then it's by serial number, so they know when that car sold and they know when they expect to get paid. Seasonal borrowing is when a business is going to stock up for the season. They need to borrow money, but it will be very short term. As soon as they collect cash on those seasonal sales, they'll pay that loan off. Interim construction loans. So while the building or whatever is being built, you can go borrow that money. So once each phase is done, you can borrow a little bit more. Then at the end, the whole amount's going to transfer over into a mortgage. There can be security dealer financing, where if it's a big broker house and they're buying and selling stock, they have to be able to buy the stock and then take the money from the customer. So there's just like a time lag between when they buy it and when they get the money from the customer. So the banks can loan them that, but I mean, that's very, very short term. And then there can be other just retail financing. Those are all short-term basis though, again, under a year. Then we have long-term ones where we're maybe buying fixed assets. Businesses buy fixed assets just like people do, cars, equipment, things like that. Project loans if they're building a new construction. If they do any type of leveraged buyout, so maybe they're trying to buy a competitor and they want to get the majority of the stock, so they want to get to own 50% of that company so they can control it. They could borrow the money from the bank until they get all of the shares of stock that they need to control that entity. They can give agricultural loans to farmers. And then we have consumer loans. So we obviously have short-term and consumer loans, short-term and long-term consumer loans. So short-term are our credit cards. If we have any type of short-term loan, like, back in the day, we used to be able to get like Christmas loans where you would borrow money for Christmas and then have like 6 months to pay it off or things like that. So just a very short-term loan. I feel like banks aren't as flexible with that type of stuff anymore. Then we have long-term loans, obviously mortgages. We have home equity loans, automobile loans, boat loans, any other type of RV or thing like that you're going to borrow for probably 5 years or 6 years. Then the final section gets into some off-balance sheet activities, because banks are very good at figuring out how to make money, because that's ultimately their goal. So, and they know that like we as consumers don't like fees. We want free checking. We want to be able to write as many checks as we can, make as many debit transactions. Like we don't want to be limited or pay fees. So they've come up with some other ways to charge other places fees. So they offer commercial letters of credit. So say if you're going to do business, and I kind of feel like a lot of times this is overseas business. So say you're going to buy something from Italy and you want them to be your vendor and you want them to send you product, which is going to take some time to get over here, and then you want terms to pay them. Well, they don't know who you are, and with so much fraud in our world, they don't know who to trust. So the bank will do this commercial letter of credit, and they will say, okay, you're my bank customer. I'll write this commercial letter of credit to that supplier in Italy and say that we'll back you up to $50,000 or whatever to enable the products to go back and forth. But there's a fee. They're not going to just do that for free, so there's a fee. Then there's standby letters of credit. So then it's more of just a general to say, okay, up to a certain dollar amount, we'll back you on that too. And then there's a fee involved in that. And one thing at the oil and gas company I worked for, we had a line of credit, which is probably comparable to this letter of credit. It's a little bit different. Like we were allowed to advance up to let's say $5 million. Like it was a lot on a line of credit. So that means we could call them today and say, hey, we need that money tomorrow. I think we had to give them a day's notice, but then we could be very quick in getting it. But in order to have that ability and that speed of getting that $5 million, we had to pay $250,000 a year. Whether we used that $5 million or not, that was an annual fee to just have that flexibility to be able to use it. And we paid it. Do you mean so and we weren't even that big of a business. We were probably, we were publicly traded, but medium sized. So banks are doing that type of thing also to make money. Then they get into the financial derivative market. So that's when you're speculating. So Enron was in that financial derivative market. They're speculating on the changes of interest rates. They're speculating on the changes of natural gas and other commodities. So that's a real high finance area. And again, it can be a little bit questionable because you're not really owning anything. You're owning the rights to buy at a certain price. And so it kind of explains a little bit about those swap contracts. So those are other ways, though, that the bank can make money. So back to that oil and gas company, we would enter those swap contracts with banks, and ours were on the price of natural gas. So we would hedge our natural gas price at a certain dollar amount, and then the bank would take the hedge. If the gas came in at a higher price than that, the bank made money. They made the difference between the hedge and what the gas came in at. If the gas price came in lower than that, the bank owed us money. They had to make up the difference. So you can see it's kind of a gamble, and you don't know which way it's going to go, but it is a way for them to make money if they gamble successfully. So then that is chapter 12.